In this video, we're going to talk a little bit more about the actual markets themselves, right? What is the process that we go through to issue securities, and where can we go to buy securities? So there are three basic cases that we'll cover here. We're going to talk about a startup company and how they finance a little bit. Then we'll talk about an IPO, an initial public offering, and then we'll talk about a multinational company. So a startup, most banks are not really interested in small companies, right? They're too small for them really to help with any big seed money. So if you think about startup financing, what kind of money are you talking about, right? Typically, you're talking about, we got to buy some equipment, right? So maybe we're talking about $250,000 to maybe $1 million to start up a business. So where are you going to get those funds? I mean, typically, it all comes from, friends and family, right? Your personal savings. We might be able to talk about some venture capitalists if it's a startup company, right? But generally, when companies start, they are very small, and the financing needs are also very small to get started for most companies. Now, if you're going to get into heavy equipment, etc., now we need to talk about where we're going to go outside of business. So it's typically not banks for the majority. So what's a venture capitalist? Well, we have people referred to as angel investors. Essentially, these are wealthy folks, and they want to invest in the company. I'm sure you've heard of Shark Tank, right? I mean, that's basically, they are venture capitalists. But one of the things you need to understand is there's really kind of two ways venture capitalism works. It can work like on Shark Tank, where you have a business plan, maybe a business is already going, and they give you capital, but they also end up with an ownership piece. And if you watch Shark Tank, that's really the biggest piece, right? Usually, they're going to want 20, 30%, maybe 40% if it's real risky. The other side of the coin there are other individuals that might not want any control. They'll just give you money, but now, of course, they're going to want a higher rate of return maybe than those other folks. So again, how the money gets there is not as important as just getting the money, right? So sometimes we can go through some internet sources, right? So they have, something called crowdfunding, and I got to tell you, I'm not really all that familiar with crowdfunding. However, I have seen a lot of information about peer-to-peer lending, where essentially there are companies that gather together businesses, and those businesses will finance between each other. And I think this is the way, quite frankly, a lot of small businesses kind of get started, is there is a business running. Maybe they're related, maybe not, and you can use some of their funding to help get your business up and going, and then you pay them back, and then hey, maybe somebody else, maybe it's a family thing, they want to start another business somewhere else. So the internet is also a place where we can go to get funds. Private equity, there are lots of private equity firms. As they mentioned here, they're pretty much kind of like limited partnerships, where they're going to provide you some money, they have some ownership, and again, it's a limited duration. Just like any other partnership, there'll be a general partner, some limited partners, and they talk about a typical fee structure is something like 2 and 20, right? So it's the sum of management fee, right? So it was like 2% for a management fee and then 20% interest on the money. So again, private equity, none of this financing is cheap, mostly because of the risk level, right? Startups don't usually make it. So if we think about these equity partnerships, right? Maybe we can get some managers to work for a long run, Maybe we don't have to think too much about short run changes. The horizon, right? The long run. Again, as I mentioned, not too many businesses that start make it very far. 3-4 years, most companies don't make any money at all for the first couple of years. So if you don't have capital, it's hard to keep going without cash. So again, in the long run, managers are under a lot of pressure, right? That once we have these outside investors, it gets even more, right? The pressure is there. You have to produce. So again, they asked the question here, how big is private equity? And again, they basically say, 5 of 10 biggest American employers are private equity firms, right? I mean, they have Walmart's number one, they're public, but these other companies are private equity. So I guess maybe another term for private equity might be a private corporation, right? It's run by people. Somebody is running it, right? But they're not publicly traded. If you think about how a company moves from this smaller kind of a business to actually starting to grow more, maybe even on a more exponential stand, they need to explore more external financing, right? We have to be able to get some funding from outside sources. So maybe this is where, again, we have some venture capitalists. Maybe we actually try to issue some bonds, but ultimately we may have to issue common stock, right? We're going to have to get some outside people to come in. Now, these outside people now are what? They are now owners, right? We're going to share the ownership of this company with these new folks. So just to speak a little bit about investment banking, right? Investment banking is a strange term. Investment bankers do not invest, and investment bankers do not bank. Their job, their title, is left over from previous decades and decades ago. But essentially, their job is to act as a middle person, right? Corporations, especially corporations starting out, don't have the personnel or the resources to understand what kinds of security should they issue, what price should it be issued at, right? How are we going to get all of this money, right? So the typical investment banking firm spreads out their risk, right? They're gonna talk to their buddies, and everybody's gonna say, hey, we need to get rid of $100 million of stuff. So if everybody gets rid of, 20 million, that means I need 5 friends. If I have 5 friends that are investment bankers, they can help me get rid of some of this. But the idea is they have the expertise for distributing shares. And that's really their importance to corporations, is to help them with this issuing process. Now, what are the risks of initial public offerings? I think it's a little bit obvious, maybe, right? Is that companies, when they're young, there's a fair amount of risk involved. But if you think about the risk to the investment banker, well, let's kind of take a step back. A corporation, let's say a corporation needs $100 million. As I mentioned, one investment banker is not going to be able to distribute $100 million worth of securities. They're going to spread this out. But what does the company want, right? The company wanted $100 million. So the way one of the ways this essentially works is the investment banker gives them $100 million. The investment banker now has all of their shares. Now, their job is to distribute all those shares. In the end, they don't want to be stuck with any of these shares, right? So the risk is all on the investment banker. Of course, they get paid very well for this. So, maybe, they decide to sell them for $100, but maybe, they actually only have to pay $80 for the share. So every time they sell a share, they get $20. So they make some really decent money. So again, in the end, the risk to the investment banker is what do they do with unsold shares? In reality, there's very little risk to the corporation because the corporation gets the money from the investment banker. At least that's one of the ways it can work. If there is another relationship or another strategy in place, maybe the corporation does take some risk, right? That, if they can't sell the last 10%, then the company takes them back or whatever. But there can be lots of arrangements, but in general, the investment banker is worried about unloading the shares, getting rid of them. Seasoned shares is when stock is issued from a corporation that's already in existence, right? So what the company might do is they may put, they take a company like Procter & Gamble and they want to issue more shares. So what they might do is say, hey, look, we need $100 million this year. So they'll maybe, as in this example, they'll try to raise $200 million. They'll put $100 million on the shelf because until they issue it, they don't have to pay interest. And then they'll issue the other $100 million. Within 2 years, this is what's referred to as shelf registration. Within 2 years, the company has to distribute the remaining part of these shares. So again, there's lots of ways that companies can issue securities to the public. Given this idea of shelf registration that I was just talking about, it just gives companies some flexibility, right? It allows you to see how well the shares are selling, etc. So there's lots of ways in which the company, through an investment banker, can ultimately get the shares out to the public. We have something called a private placement. So the process is companies have to register with the SEC before issuing shares. And that's a pretty expensive and long process. So again, what they might do is try to distribute the shares to some single institutions. So maybe it kind of sounds like a backdoor transaction, and that's sort of what it appears to be. So, I have these 10 friends. Each one of them has some money. I need $10 million. So I get each one of them to buy $1 million worth of my shares. I don't have to go to the public. I don't even have to go through the investment bankers because I already know who's going to buy them. Now, the problem with private placement is it is kind of backdoor. So there are regulations in place that require some control. They had something called a rule of 144A. And historically, what this rule did is says, if you buy private placement securities, you must keep them for a whole year. Well, they've adjusted that rule a little bit. So now it allows you to trade privately placed debt and securities, but only among institutional investors. And the reason for that is there's really no information out there about this money or the purpose for the money, right? The idea of registration is to inform the public of how much money we're gathering, the price, what it's going to be used for, etc. So really, there's kind of, as they mentioned here, two parallel markets, right? One is public and the other is institutional. And of course, what happens when we have two markets? Generally, the markets work very smooth and very well. So we don't have to really worry too much about it. There's enough regulation to help us out. Internationally, I'm sure you know there's an international market for securities. Foreign companies can trade their shares in the United States. However, they have to follow our accounting rules and our SEC guidelines. So not just any company can trade on the New York Stock Exchange, for instance. They have to fulfill the guidelines of our domestic securities. That's why some companies just won't trade in the United States. So there are international companies that if you want to buy their stock, you have to go to the Nikkei exchange in Tokyo to buy those shares because they have decided, usually because of money, because it's pretty expensive, that they're not going to trade in the United States. There's lots of companies have, again, guidelines, etc. We have what they refer to as reserve requirements. Some companies, again, internationally, they may have to have a certain amount of money within the United States as a register, on the side, right? Just kind of rainy day money, I guess, right? But this is there to make sure that if they're struggling domestically in their country, that there is some money here that can help with interest payments and etc. Bearer bonds are basically securities that have no name on them. So there's just a number. But whoever has that bearer bond in their possession, they own it, it's theirs, right? So again, there is some regulation, but then foreign institutions, from time to time, they try to get around that regulation, right? Because it's easier, quicker, cheaper, more convenient. Just a couple things about regulation. I'm not real big on remembering and understanding all there is to know about regulation, but there are two acts that are in place that are pretty important, I guess. The Dodd-Frank Act is all about controlling financial services and financial institutions. It is fairly restrictive from what I understand from my banking friends, but they've been looking to lighten it up a little bit. But it all came about because of the mortgage crisis in 2007, 2008. Sarbanes-Oxley also coincidentally came around that time. And I think the most important part about Sarbanes-Oxley is it requires the executives, the CEO and the CFO of a corporation to sign their independent audited financial statements, claiming that there's nothing illegal in there. So what happened historically was, you could sign your name, and if it turned out there was something illegal, the penalty was a civil penalty. But now Sarbanes-Oxley has turned that into a criminal penalty. So even though it's not jail, most executives don't want to go away. So I think the major outcome of these two things is that the financial statements that we see have higher quality. Now, of course, there's more regulation always slows down business to a certain extent. So what does it cost to issue securities? Well, there's something called a spread. This is what the fee that goes to the underwriter. It's the difference between the selling price of the stock and what the investment banker is paying for the stock. There's all kinds of other fees for legal, accounting, etc. And frequently will underprice stocks. This is especially true if stocks are their seasoned share. So if you think about it, the reason I'm issuing stock is because I need money. but I already have stock that trades on an exchange. I want to get investors, instead of buying the old shares that are already on the exchange, I want them to buy these new things. So I might underprice it. So I might say, look, you can buy it for $3 cheaper from me, or you could buy it from the market like everybody else. So underpricing allows companies to steer investors, new owners, to the new shares rather than shares that are already trading. So they do some examples here of some issue costs. They want 10 million shares. Price is $20. The underwriter is going to sell it for 19, so that's underpriced, and they're going to have a spread of $1.50. So that means that the underpricing is what? It's $1. It's $1. So the company ends up with $17.50 times the 10 million. That's 175 million, and the underwriter gets $1.50 times 10 million, or 15 million. And so when you add that together, we understand that the company gets theirs and the underwriter gets theirs. And again, I'm not going to go through this example. If you look at the notes, the PowerPoint and the notes, you'll be able to see how this works and work way through the example to find out, how much the company gets and how many shares have to be sold in order for the company to get what they need. So if you think about it generally in the public, what are the costs, right? If it's a straight debt, right, just a straight kind of a bond, typically the costs are around 2.2%, 3.8% for convertible bonds. If it's a secondary offering, right, there's other offerings going on for public companies, could be 7.1%. IPOs, again, it's very expensive to issue, to raise that kind of cash. It can be up to 11% or more are the costs for having an IPO go through. So again, if you kind of think about it, the bigger the issue, the lower the cost per share, right? So again, if it's the cost might be high, but in the end, if you divide that by 100 million shares, the cost drops per share fairly low. So again, that's the general idea about investing in or getting shares issued and what the cost is. Look forward to talk to you in the next video.